In January 2007, the first U.S. bank failure occurred in the lead up to the global financial crisis. By October 2007, 6 major banks had failed. This was the moment where the U.S. stock market made a peak that wouldn't be revisited for 5 years. During this time, between January of 2007 and October of 2007, an indicator called the yield curve did what we call a steepening. This is when the yield curve comes out of an inversion, a phenomenon typically recognized to be an imminent recession signal. You can think of the yield curve inversions that are highlighted here as the conditions that are needed for a recession to occur, and the steepening of the yield curve as the market beginning to price in the fact that a recession is actually occurring. And indeed, between January 2007, when that first bank failure occurred, and October 2007, by the time 6 banks had failed, we saw the yield curve steepen significantly, and the 2007 recession began in December, just a couple of months later. Today, since March of 2023, we've seen a grand total of 6 bank failures. And during this time, between March of 23 and today, we've also seen the yield curve steepen. So then why is the stock market so strong and surging to all-time highs? Well, first of all, arguably in October 2007, the market was also surging to all-time highs, and many investors thought that this could last a lot longer. But when we look at the yield curve, we can see a significant difference. This steepening that we saw in 2007 looks a lot more significant than the steepening we've seen since March of 2023. And we actually know what the underlying cause for this steepening was. If we add oil prices on top of the yield curve, we see that between January of 2007 and October of 2007, oil prices jumped by around 90% during that period. You can see this coincided exactly with the steepening of the yield curve. In fact, we saw the exact same thing in 1990 during this yield curve steepening that led to the 1990 recession. It coincided exactly with the moment where oil prices doubled in a very short period of time as a result of the invasion of Kuwait. Oil prices are an incredibly important component of financial markets and heavily influence consumer behavior, inflationary pressures, monetary policy, business profit margins. In fact, this chart right here shows us all of the oil shocks that we've seen throughout the last 50 years. And pretty much every single one of them has led to a recession, with the exception of the 2022 oil shock that you can argue was avoided through huge fiscal spending. But today we don't have any type of oil shock. Since June of 2022, oil prices have been on a steady decline. We did see one brief surge in oil prices in the second half of 2023. And interestingly, when we look at what the yield curve was doing, it was steepening during this period. So this part of the yield curve steepening was due to rising oil prices, just like in 2007. But ever since, oil prices have stabilized and the yield curve has stopped, and financial markets have stopped being worried. This does show us, however, that if oil prices were to rise, it's going to drag the U.S. economy into a recession. But oil isn't the only thing that could cause this type of fear. For example, when you take a look at this steepening that occurred in March of 2023, oil prices during this period were actually falling. This was a result of the banking crisis that occurred last year with Silicon Valley Bank failing. The financial stress that would result from multiple banks failing immediately led investors to be concerned about a recession. Luckily, the Federal Reserve stepped in with massive amounts of liquidity here, and those concerns were quickly reversed. We can say this also happened in 2020, right here during the pandemic, when investors were concerned about the financial stress that lockdowns would have on the economy, and so the yield curve steepened, and this time a recession actually did occur. We have one more example a little bit further back of the yield curve steepening in 1998. This was a result of a massive hedge fund failing. Again, it caused many people to be concerned about the widespread effects it would have on the financial system, but the Fed stepped in to save the day by cutting interest rates, which led these concerns to fade away. So from history, we see that rising oil prices, bank failures, pandemics are all things that can cause financial stress and lead investors to become concerned about a recession. Sometimes these concerns are just temporary, and sometimes these concerns actually do end up leading to a recession. Today, when we look at the yield curve, yes, the conditions are in place for a recession to occur, but since October of 2023, there's been no apparent financial stress that is hurting the economy in a way for that recession to occur immediately. Unfortunately, today's market is a lot like a game of musical chairs. And the moment that the yield curve begins to steepen, that's when the music stops. For now, the music is still playing, which was one of the key reasons why we were expecting the market to put in a significant bottom after the 6% correction that occurred in April, and why the trades that we added here are already up quite substantially. We're monitoring the yield curve very closely, listening to what it has to say. We're also looking closely at employment numbers to see if the job market remains strong, and of course oil prices, because as we discussed, if oil prices begin to rise substantially, that's going to drag the economy lower.